Hey everyone, welcome to our panel of VCs and what they look for when they invest. We have three venture capitalists from New York here joining us, and I'll let Mike start. And we'll go around the room just to get introductions.
Great, thanks Nick. My name is Mike Pio Roda, Noise Ventures. We are a early stage pre-seed to Series A investor within the creative economy. We focus predominantly on creative entrepreneurs, the ones that have creative backgrounds, since we believe typical investors typically look past them because they see them as this passion plays. We invest in them because we believe that they are actual businesses.
Great. I'm Lorine Pendleton. Actually, my current fund is Rising America with Portfolio, Fund 1 and 2, investing in seed and Series A companies that are basically underrepresented founders. And so we've actually industry agnostic, so we've invested in a lot of different industries, fintech, edtech, health. A couple of consumer companies. My new fund, 125 Ventures, is launching shortly, and it will be investing in seed and Series A companies, focused on media, entertainment, and sports at the intersection of tech.
My name is Brian McCullough. Most people know me as the host of the Tech Meme Ride Home podcast, which is a daily tech news podcast. Super connected audience listens every day for the tech news. If you are a listener to the show, then you would know that 2 years ago, at the end of the show, I said, if I did a rolling fund, would anyone go in with me? And so all of the LPs for the existing Ride Home Fund are listeners to the show, names you would know. We bring all of our portfolio companies onto the podcast, and thus we tend to invest in pre-seed and seed, because having our distribution platform is really powerful for companies at that stage. By the time people are watching this, also our second fund is going to be coming out. It's going to be the Ride Home AI Fund. Chris Messina, the inventor of the hashtag, is my partner on that. And we're looking for AI seed and pre-seed. So
I want to dive right into the question. So what do you look for when you invest into companies? The big question, a lot of startups, a lot of founders are looking for venture capitalists to invest into their companies, and we want to shed some light on that process, and we'd love to hear some feedback from you guys. Would you like to start off?
Sure, yeah. So what's really important when looking at investments, the team is really important. There's a saying in VC, bet on the jockey, not the horse. So, I think a lot of companies have to pivot. So you want to have a team that's able to pivot. They know what they know what they don't know. They're able to get advisors and surround themselves, with great people. The other thing is, what's the problem? It should be a really big problem with a big market attached to it. I always tell people there's something, is it a vitamin or is it a painkiller? So people want a painkiller. Vitamins, yes, you should take vitamins. We all should, and not everyone takes it. But, if you don't take it, it's not the end of the world. But if you have like a throbbing headache and, you can't function, that's a painkiller. So you want the product or service to be more of like something that is a painkiller, a necessity people really want to get. What's their financial model, business model? How are they going to make money? Show me the money. That's what I think of when I look at companies. And so really need to have a way that they're going to make money, because then that's how we'll all make money. So those are kind of the key things that I look for when making investments.
Thank you. Brian, what are your thoughts on this question and what Lorine said?
I mean, it's hard to be specific, because if there was, 5 different criteria, then, you could do it with a little matrix or whatever. But, every founder is different. Every idea is different. So then, of course, the people and the team, super important. Do they have some sort of expertise? Do they have some specific passion? Do they have prior experience in the space that they're, trying to go into? I do like the idea of, half the companies, more than that, pivot at some point, usually within the same sort of furrow that they were going down, but sometimes in a completely different direction. So seeing a team that seems to be competent and nimble is great. But then my favorite entrepreneurs are the ones that come with this burning idea. Like it's a passion in a sense that, like you're saying, this is a problem that needs solving. Like, I love people that have that sort of a burning passion, because then it's halfway to finding product market fit, because you have an intuitive sense a lot of times of what the pain point is and what the pill that you're going to give people to make the pain go away might be. So it's always so hard to get any of us to pin down what your criteria is, because it's not hard and fast. A different entrepreneur could come in tomorrow that would break any rules that I traditionally would have, and I'd jump all over them for reasons that I haven't even just elucidated. So,
well, we'd love to dive into those reasons.
Yeah.
And I think we're going to do that into this conversation. So, Mike.
Just really quick, like everyone here touched on points that are like spot on. Like, and I think we can all agree here that for early stage, specifically pre-seed to Series A, it's really driven by the founders and the intangibles that they actually carry. So if they can pivot when they need to pivot, when they're self-aware to the point where they know when to take advice and when not to, I think that's the value of where we kind of need to focus, and it's the founders, the type of founder that you're actually backing, and the personalities there. And that may be a loaded question or like a loaded criteria, because you never really know, and there's really no way of measuring it. But that's really what it is, I think.
we all three of us do seed, right?
Mhm.
Okay,
Yeah.
and I do some pre-seed, and so one of the cliches is often that VCs look for people for whom this isn't their first rodeo. And by that, it doesn't necessarily mean an exit, but like, have you worked at a startup before? Have you worked in the space? I'm actually throwing a question out that, to me, especially in pre-seed, and I can give you a specific example later, but any kind of experience in whatever the sector is, whatever the angle is better than just the idea, especially as early on as you can get. Do you?
I agree. I mean, most of the companies I've invested in, as you were saying that, I was trying to think of company that I invested in that didn't have a entrepreneur who had an expertise in the area, or either, they may not have ran the company, but they worked in that industry and they understood the pain point of that industry, understood the industry, they didn't know everything about it, but then that's when they brought in advisors and other people. But pretty much all my companies have someone who understands that industry, or worked in it, or some kind of exposure to it. So definitely.
That founder market fit.
Right.
It needs to be a fit. Like for us, like we've been in media for like ages, and if there's someone, and it's such a relationship based like sector, that if a founder isn't from media, it's just tough to pass that hurdle. And I think it applies to pretty much all the sectors or industries and all that.
That makes a lot of sense. My second question was going to be, how do you evaluate the potential of a startup? And so, we got one check there. So you guys look for prior experience in the field. You'd like to have a founder or someone on that team that has prior
It's
experience.
helpful.
In that.
It's
okay.
Very helpful. Yeah.
What other things do you look for to evaluate that startup? What are things that sort of stand out to you guys? Anyone want to take a stab at this?
No, I'm thinking, just again, back to like that problem. It's a big enough problem. It's something that you have a solution, people are going to pay for it. Ultimately, that's like the biggest thing, big enough market. Say if it's a very niche, small market, in VC, we need to have exits that are going to be multiple exits. And so meaning that your revenue has to grow. And so if it's a very niche and small market, that's not really something that I would invest in. So big market, you have the right solution for it. I think it's a viable solution. I think people will pay for it. You have a great business model, you're pricing it the right way. So those are the things that, in addition to like the team, those are the things that I look for.
Team, product, market size.
Yeah.
Cool. You guys have anything to add?
Market size is like one of the top ones for me there. I also like seeing, depending on the founders, the community that they've built around them. Like how defensible is this? Is their brand, is the brand defensible? Technology defensible? Just that community, that network effect there. So it gets them to scale and better, like easier for adoption, like sooner than later.
Network effect is great. It helps build on the business.
I always say that people underestimate the fact, if you can come to me and you can show me any sort of traction at all, as opposed, this is hard in pre-seed where it is sometimes just an idea, but it's not that hard even if you have just an idea to throw something up on GitHub or test with friends or have it, like you're saying, with a community, like have a Discord channel with, potential people that might want to use the product or whatever. Even if it's still just an idea, any work that you've done that can be like, no, look, actually, this is something that people like to use. It's not that hard to do. So somebody that comes to me with just the idea versus somebody that comes to me with just the idea, but also, hey, look at how people are already transforming this over here, doing this and that with it. You're giving me more, positive signs that you're onto something.
I would just add to that something as simple as putting up a landing page where
Right.
you promote, hey, coming to market soon, and then, throw your email in here to get updates, and then say get 1,000 people who've given their email. That shows that there's a market for it. There's people who are interested, and that's not hard to do. You put a landing page up, you promote it or whatever. And so that's another way, that you can show that there's an interest in this or a potential market for
right.
this.
And a founder might say, well, but it's a SaaS product I'm going to sell into the enterprise. I don't know until I have it fully developed yet. Not necessarily true. If you have an MVP and you can just have somebody use it for 2 months for free or, whatever, that also shows me that you're further down the road to figuring out product market fit, but also working out the kinks sooner rather than later in terms of what the product actually should and shouldn't be.
Or you could have customer discovery interviews where you interview, say that you haven't built the product, but then you get a list of people and you do 30 interviews and, what's your pain point? And then you kind of say, look, I conduct these interviews. It, confirms, how am I building this product and what's the pain point and how I'm addressing it. And so that's another way if you're pre-seed and another way to go about it.
It's a lot of great feedback. I want to switch gears a little bit and sort of ask another question. How involved do you guys get with the startups that you're investing in? So you guys seem like you have a lot of experience, and I like all the conversation that you're having. How much work do you guys do with the founders, or do you just sort of write a check and hand it to them?
I'll start with this one. That's a loaded question because it could be as much as you need to and as little as you need to. I'm always under the impression that no news is good news unless it comes to founders. Sometimes you just need that feedback. You need to understand where they're at, the type of help that they need. For us, we want to be needed. We want to be of value, whether it be through helping with business development, helping with networks, advisors, or just connecting them to the right people. But at the same time, we want to invest in founders that we trust. So if they don't need the help and we see that they're doing well, we'll step back a bit. But once they hit a wall, we'll be there to just kind of help them out, be their mental health support too. Because every founder has those days when they just want to give up. But we're there for that support when they need us, and we'll provide as much support as we believe that we need to give them. So hopefully that was
that was a great answer. It seems like you guys all have a lot of great experience. So I think it seems like a lot of founders probably lean on you guys with your experience and your connections.
For me, so our fund, the current fund, we don't lead, so we don't get a board seat. We have a couple of board observer seats. So, someone who's leading, they're going to have a board seat, they're probably checking in with the founder every week, but I have founders who I've really worked with and opening up doors, connecting to other investors, potential customers. So I tell the people there's 3 C's in capital, financial capital, which we're doing, writing the check, but also social capital. So opening up our network for them. So say they have a product and, a SaaS product and it's a certain industry. And so tapping our network to see, how we can help them get in front of potential clients and customers. And then human capital, so I used to be an attorney. I was also a business development executive of a number of startups. So I have that expertise or, so can try to help them in terms of, what I can, in terms of human capital, that kind of thing. And also my fund partners. So, I think those are important ways of helping the companies as well. So,
yeah, I mentioned that my fund's primary superpower is the podcast megaphone, but even then, I only offer it. I don't ram it down people's throats. There are portfolio companies that I still know when they're going to come on because that's when they'll come out of stealth or when they're going to announce their next round or what have you. There's other companies that maybe will never come on. That's fine. So I think that we're all expressing the fact that we're as helpful as is required. If you have an experienced founding team. There's a bunch of ex-Twitter folks that I just invested in. Again, not their first rodeo. Their previous startup sold to Twitter. I'm staying out of their way. Like, they seem to have a clear vision of what they want to do, and I'm here whenever they need me. There's other less experienced founders for whom it's like, oh, can you introduce me to our UI is terrible. Okay, I got someone for you. That sort of thing. Introductions and stuff like that. I think introductions are always valuable. Even if people don't know what you know or who you know, like if you just start touching base with your founders and they're talking about something and it's like, oh, I know so-and-so at Microsoft, maybe we should open up a channel with them or something. You never know. So I think you stay out of their way, you give product advice and strategic advice where possible, but always make intros.
All right, I'm going to ask the next question. What are some common mistakes startups make when raising capital? Brian, I'd like to start with you.
The most obvious one is asking for too much money or too little money. This is not so much a problem as it was 2 years ago, where a pre-seed would come in and want a $25 million valuation or something. Some of this is market related or something, but the founders that come in and immediately are asking for way more money than where they're at or what the potential of the company is, says to me that they fundamentally don't understand something about their company or their company's place in the market at the moment. And then, as we've been seeing with companies that took a lot of money in the recent good times and took too much money, and now are going to have a hard time raising again because they took too much money. Again, there's no science to this because every company is different, but I always, again, especially with my seed companies, take just what you need to prove yourself for the next stage. Don't get starry-eyed about it. Just do the minimum to get you over the hump, but no more is what I try to say.
I'll just double click. I mean, I think you were also alluding to the valuation. There are companies who they come in, they don't have a lot of revenue. They're not that far into the product market fit, and they're asking for like a 20 million valuation, which is unrealistic. Just really unrealistic, and not knowing what the market is, like what the current, particularly, well, now, I mean, I think things have changed. Valuations are going down, which is good for investors. And so, just so people know, if you don't know, we want the valuation as investors to be as low as possible. We're not trying to cheat them, but the lower the valuation, more equity we can get for that check that we write. And so founders want the valuation to be as high as possible. And so, if it makes sense, yeah, $20 million makes sense. It should be some type of multiple on your revenue, looking at the industry norm, like what are similar situated companies getting for valuation. So that's one thing. The other thing is, I think it's not a one-way street. I tell founders, as much as the investors who do perform due diligence on you need to do that on investors. So it's a marriage. Like this person investing in your company, you're stuck with them. And actually, it's probably harder than a marriage, because a marriage, you can get a divorce. In a startup, it's hard, to get rid of your investor. So you need to figure out, talk to people they've invested in. How are they? You don't want someone, like we talked earlier about, we know enough to get out of the founder's way, let them do what they need to do, but we're here if you need us. You don't want someone micromanaging you and calling you all the time and I want an update and all that. And so, and just make sure that they're a fair person and a good person, right? That's what I would think of if I were a founder. And so doing that due diligence, I think a lot of founders don't do that. And I think that's really important. And then I would say, just really be real. How are you going to make money? Show me the money, be really tight on that. You have to know how much you have to price your product or service or whatever you're doing, and how you're going to make money. And I think, really have to have that. Those are things that I think mistakes that maybe not doing that is some of them don't have such a tight pitch and have thought about the financial model.
Startups giving up too much of their company too early. I've seen some pre-seed seeds already down to 40 to 50%. and don't give up too much too early for too little at that point. Like they haven't done their due diligence, they haven't looked at what they're really valued at, and at that point it just seems like they're just looking for an exit.
I think it's very important. Like, so you're talking about giving away too much of your equity too soon, and I'm talking about like taking too much money. Like maybe we should talk about like getting those dollar signs in your head. Like it can kill your company. Not only if you take too much money, if you take a $20 million on a seed or something, then what do you have to raise to get the next? But then the other thing that I've seen a lot of times is companies that have too much money, they spend it when they shouldn't have. Right. So it's like, it's counterintuitive to some founders because they think, well, I'll raise the most money that I can because then the world can go to hell, but I'll have runway for 10 years. But no, you won't, because then you'll just have a zombie company if you can't ever raise again.
Yeah.
I would just add to that, like, because I'm investing in mainly women, diverse-led companies. Unfortunately, they don't have that. They don't have that problem. The problem they have is like they're bootstrapping it. They don't have a lot of money. You know, people won't give them as much money. You know, there's a fintech company I invested in, and you know, her competitor got like 200 million, and she's built a product I think superior to the competitor, but a big, but she's a Black woman, and so it's been hard. I mean, she has raised about she's about to do a 10 million round, but she's raised about 40 million. But you know, if she were not who she was, she would have raised a lot more money. But I think in some ways it's good because it keeps her scrappy and, not wasteful, and just like, keeps you hungry because you don't have the luxury of like, you have to be really efficient, capital efficient. So most of the companies I invest in don't have that issue.
But do they have the issue that he was speaking to, which is because they can't overraise like some of their peers? Are they being forced into situations where they're giving away more equity than you think is fair?
I mean, that's, I have seen in the companies, I mean, luckily they have good counsel and they're not doing that and they're not being desperate. I mean, I'm sure, yes, probably some have, of course. Yeah, but, I would say the companies I've invested in, that hasn't been the case. But yeah, that could be an issue too, because you're so desperate for cash, you'll take whatever deal someone's giving you, give up maybe too much equity or, but yeah, that can happen too, definitely.
What are your thoughts on bootstrapping versus raising capital?
I mean, I'm all for it. I'm a fan of people who bootstrap, get to as far as you can go, like think of it as like a track, get to like as close as you can to that finish line. And then, for you to go further, if you need to take on money, that's fine, because then you're giving up less of your company. Your valuation is more, will be more. And so if you're able to do that, the reality is certain industries or certain things you're building, you can't, like as a biotech company, like you can't, it's very hard to bootstrap unless you're independently wealthy and you can do that. Most people aren't. So certain industries are capital intensive and you need capital, but some industries aren't. And we talked about ways that you can show there's a market for something and, try to build or whatever you're doing as quickly as possible, get some customers. So I'm for people bootstrapping as long as they can.
Cool, thank you. You guys?
I think I'm okay with both. Like bootstrapping is great, but it also comes down to, I guess, the privilege that a founder has too. Like that to bootstrap, you have to have some money. You have to have some capital behind you. And can they not? That's just an ethical dilemma, in my opinion. But if they can bootstrap, kudos to them. Do it. It's best to do that anyways, in my opinion, so that they could they could give up a lot less equity when they need it. But unfortunately, some founders can't do that. So I'm easy both ways.
But to just elaborate or kind of expand on what you were saying, I totally agree. Because I mean, I'm working with a lot of founders who, they don't have the wealth. They can't just like, hey, I'm gonna like spend a year working in my company. Like they can't. They have to like bring in money. So some of them, when they started out, this was like their startup was their side hustle. So they had their job to make money, and then they focused on, building their startup. And then when they got to an inflection point where it cost more for them not to be focused on their startup, then they quit. But, but yeah, you bring up a really great point. Not everyone has the luxury of just, kind of not having any money come in as they build their company.
Entrepreneurialism can encompass everything. And we're talking by nature of what we do and what we invest in, at a different type of company with a different type of scale and expectations for returns and things like that. If you can found a business and never ask anyone for an investment and never have to give away a piece, I mean, look, that's you're probably, it's a faster way to get rich than to go through people like us.
Well, most companies that are started are companies like that, lifestyle businesses. And so you may bring up a great distinction, lifestyle versus venture backable, highly scalable businesses. And so the majority of companies in the United States are lifestyle businesses. And a lot of them, I mean, they have like EBITDA of like, 30, 40, I know some people have companies, 30, $40 million. Maybe they take a bank loan, operating loan or whatever for operations, but they didn't take out outside investment. And that's a great business. And, it can be generational, they can hand it down, which is also actually an issue now because a lot of baby boomers, the kids don't want to get into those businesses. And so there are people who are starting funds where they're buying those kind of businesses. So that's a whole other issue. But yeah, no, I mean, most companies in this country are lifestyle businesses.
Can you guys talk about some companies that you invested in that were successful?
Sure, I'll start off. So we invested in a company about just over 3 years ago, Canela Media. Really interesting story. It's a streaming service for the Latinx market, ad supported. So, people use Netflix, you pay a subscription. Interesting thing is she had she had a company before she exited. It was a modest exit, and then worked at another company. She wasn't the founder, but it had exited. So again, back to domain expertise, ad tech. She knew about ad tech, streaming, all of that. Literally went to over 100 VCs. All of them said no. The only VCs who invested in her were women or diverse-led VCs. Happy to say she's gone on. She raised a Series A 2 years ago. She's on track probably to be $1 billion valuation of company. She's now the third largest media brand for Latinx market, and just is really killing it. Now has over 200 employees. She launched Canela Sports, which did really well during the World Cup. Canela Kids, which is like the Nickelodeon for Latino kids. Canela Music. So she's like, now she has original content. She was licensing content. Now she's created original content, and has been a rocket ship. And what was really interesting is what I love about this company and like this story is that had funds like mine had not exist, she would not be in existence.
Wow.
And so we saw an opportunity, and other VCs didn't. And they said, people can watch Netflix, there's Spanish language content on Netflix or Amazon Prime. Yeah, there is. But you know what? A lot of Latinos, half of the under and unbanked people in the United States are Black or Latino. They don't have a credit card. So she saw an unaddressed market, a need, again, this problem. She had a solution, and now she's doing incredibly well. So that was a blind spot a lot of VCs missed out on. And of course, in her Series A, they came running, and she selected who she wanted to have a seat at her table, or be on her cap table, I should say. So
great story.
Thank you.
Brian?
I've only been doing this for 2 years, so there's not a ton of winning stories yet, especially because I do pre-seed and seed. So the seeds are still coming up. But ironically, the one that's gotten the furthest ahead is the second investment I ever did. It's a company called BioCortex, which of all things is a biotech company, which I have very limited experience in. So a total flyer for me to make my second investment. But fortunately, I have LPs that are very prominent in biotech and will help me evaluate it. But funny enough, what BioCortex does is it uses AI to analyze your gut biome and create patient profiles to determine, I don't know how much people know this, but your gut and your flora inside your gut affects a lot of things in your body. Also, how medicines will react. So this was before the AI boom of the current minute. This was a total flyer by me, but they are working with some big name pharmaceutical companies essentially to evaluate how existing drugs and new drugs would interact in negative ways or even positive ways with various population profiles. And they're well on their way to raising a big next round. So totally out of left field, but that's my biggest success so far.
That sounds incredible. It sounds very cool too.
So similar. I'm a newbie
Mhm.
in terms of the investing realm. I've made a couple previous investments in Vyas and are doing just about to launch our fund with a couple investments next month. But one company I was involved with that was a success, probably 2015, 2016. It was originally a loyalty rewards platform that was servicing retail brands, clothing brands, predominantly fast fashion. But when we were chatting and we were looking at ways to increase their market share out in Southeast Asia, we realized the technology that they had wasn't meant for loyalty. We pivoted, got them to pivot into the live event space. They were using NFC technology at the time, well before others in the region were. With what I was doing at the time, I was a concert promoter working with music festivals, a lot of brands, a lot of concerts and promoters. We got them access to a number of venues, festivals, and by the end of the second year, they were servicing a little over 3,000 events and over 700,000 or 800,000 attendees at that point. And they got funded, did well. So,
Wow.
One good success story there.
So let me follow up with that question with another one. What are some similarities or characteristics of companies that maybe you invested in that weren't so successful? What maybe is there any commonality there that you guys found?
I'll start. Haven't had one just yet, but I have monitored some startups that we were thinking of investing in. And one main characteristic that we've kind of noticed was just how do I put it nicely? Frivolous spending. So I think that's the main characteristic that we've seen, and just founders that know when to that just can't take no for an answer when they should be taking it. That might be a bit broad of an answer, but that's something that I would see.
You guys have anything to add?
Well, yeah, it was my literal first investment I ever made as an angel. I started as an angel investor, and company was great. It was a CPG, a consumer packaged goods company, organic baking and baking goods and organic non-GMO. So this was like 10 years ago. Organic and all that stuff is like she was at the beginning of it, took off. She had the pipe was 2 million annual revenue, which was good. But it's a very capital intensive, you put your stuff. She was in Costco and big Kroger's, big, grocery stores. The timing of it, it's usually like net 60 when they get paid, but she has to manufacture all the stuff. And so she was supposed to take on investment, and this was like putting all her eggs in one basket, and the investor pulled out at the last minute, and she couldn't get any other investors, and, had to fold the company. And it was like really terrible because great branding, she had great traction. And so I guess like the mistake was not diversifying like who your investors are in terms of, yes, this person said they may lead, but you also have to you can't just put all your eggs in one basket. You have to have other options, because what if that falls through? So it was a mismanagement on her part as a CEO or founder, CEO. And it's unfortunate because it was like really great product. People loved it. But, there was some missteps. So
Great insight there. Don't put all your eggs in one basket with your investors. Diversify your investors.
Or your customers or anyone. I mean, yeah.
Great takeaway there.
Yeah, I'm going to say something similar. Of the 45 investments I've done in the last 2 years, only one, thankfully, has had to throw in the towel so far. And it was for a similar reason, where it wasn't just the investment that had to come through or we can't do this. It was also the customer that had to come through, or they couldn't go to the next level or whatever. This company in particular, which I love the team, love the product, they were so focused on the growth that they missed the giant hurdle coming at them until boom, it hit them in the head. And it's like, so they were putting their hands in this pie and that pie and dreaming big of like what was going to happen but they didn't make it over the hurdle. Like one of the things that you like to see in your founders is obviously product market fit, great product ideas, finding, passion and connection with customers and things like that, but also de-risking, eliminating the ways that even if you're killing it on every other metric, eliminating the ways that your company can still die. Because there's dozens of them for any company. And so a good entrepreneur is growing, but also de-risking, taking away those things that could potentially either kill you or cut off whatever good work that you've already done.
I guess part of it is always diversifying your revenue and like back to like, don't put all your eggs in one basket. I think I'm business development head, like think about ways you can monetize in different ways, not just one way, but monetize in different ways, I think. And I think that de-risk the company.
There's a million different ways your good idea cannot succeed. And so if you always keep those in mind and you're like, okay, but if we did this, we could check that off the box. We'll never have to worry about that again. And, some of those things you can never check off the box. If one of the things that could kill you is a huge 800-pound gorilla company in your space suddenly decides to compete with you. But if you always know in the back of your head that that's probably the existential threat that you'll face someday, preparing for that from day one is also like preparing for the ways that you could get kneecapped, and eliminating them when possible is a really important skill.
That's great. I think we spoke a lot about the startups and the founders. I would like to talk a little bit about how you guys like to be approached. So what are some of the best ways, or the best way that a founder or a startup can approach a venture capitalist like yourselves, and how do you guys like being approached?
Well, I get a lot of my deal flow from my audience, so I take a lot of random from left field, and I field it all. So I'm happy to take that. So I'm not generally one of those people that's like, well, I have to be introed by someone that I trust. But having said that, if people don't understand why VCs tend to operate that way, it's because if somebody is willing to bring somebody to me, they're taking reputational risk. So it's not just that I will only take, if someone brings me a company and I know them and I already trust them, I value that, but I know that at least they have skin in the game to make that intro. That's why it's extra valuable. It doesn't, an email or a cold whatever doesn't really cost anything. But if I know that somebody's sticking their neck out for something or someone, then that gives me a little extra interest.
Yeah, I mean, well, it's a relationship business, and so certainly when I think about the companies some of them I've invested in, it's come through a referral of like another investor or a friend said, take a look at this. I do get a lot of like inbound, like random emails, like just I don't know the person. I have looked, it's a lot. I'm going to be honest. I haven't looked at every single one of them, but there have been ones where I've like looked at them like interesting, and I've actually met with the founders. With the new fund, I've seen some investors doing this, like, have something on their website where people can submit, the companies, particularly for, women and diverse founders, they may not have the network that other people have. And so I don't want that to be a roadblock for them not to get funding because they may not have a network. I believe, talent's equally distributed, opportunity isn't. And so it could be someone who's like in the middle of like Oklahoma, and because they don't have that network, but they may have an amazing idea. And so, I want to be able to feel that. So, but that's going to take like screening, but I know, I've talked to some funds they do that. They have like, anyone can submit, and then they go through and they either have, people on the team kind of screen it and look at it. So I want to be able to do that as well. But, it takes resources but yeah, I mean, I welcome people reaching out. What I would say is if you want to get in front of investors, go where they are. So go to like pitch demo days, investors go to that, even if you're not pitching, and just get to know people. Again, it's a relationship business. So yeah.
Great
feedback. And Mike, we'll close out with you on this question.
And very similar, like for our deal flow, a lot of it's coming, well, good chunks coming warm from like behind the scenes managers, some of our creators, they come to us directly with like ideas and like their colleagues pitching to us. So those are warm. We do have an open inbox policy, so they're always welcome to email. Always open to email. We also have a pitch form online that's about to launch. And we get a ton of in-depth emails, and that actually raises a question that I actually want to toss to you two. What do you think of founders buying lists for investors for them to just email out? Like, what's your take on that? Like, I've been seeing a lot of these in my inbox, and none of them are targeted. Like, I get a lot of healthcare emails, even though I don't deal with healthcare. Like, what's your thought on that?
Well, it's taking the time to do your homework. I mean, I get emails for, I mean, if people looked at what I invest in, they would know I'm not a fit. And so I think, I've been noticing that. I guess I didn't realize like that's a thing, but these like blanket emails, I mean, those I just disregard. The ones that I disregard are like ones that just don't fit. Like it's obvious they haven't done the research. So, if you're going to send a cold email, research, like make sure that investor invests in your space at your stage, that kind of thing. So, yeah.
I mean, if there's a cold inbound and it's obvious that they just went down a list, then it's worthless, and for both parties, right?
Mm-hmm.
At the very least, like you're saying, you should know, have I invested in a company like this before you reach out to me? Is this a sector, even though I just said biotech, don't send me biotechs, because 9 times out of 10, I'm not going to know whether,
Right.
like, so if it's very obvious that it came off a list, it's not doing either side any good. At the bare minimum, if the inbound has done enough homework to be like, I can make a case that I think this would be interesting to you, then it's like, all right, if you've done that much work, then I want to see why you're either right or wrong about that. So, yeah.
I think from the email standpoint, like there's so much out there. A lot of, I guess, companies selling email lists from like the NBCA or like the CBCA or other like venture lists from like conferences, that it just almost seems predatory to a degree.
Yeah.
Just because they're making money off these pre-seed companies that just want access when these lists are actually available online for free.
Mm-hmm. That's a great point.
So the key takeaway for our listeners here, make sure you know the venture capitalists that you're pursuing, make sure you know what they've done in the past, and make sure it's a good fit for you. Don't send out cold emails. They might not get opened. They might not be read. Let's move on to the next question. I know we touched on this a little bit, but I'd like to go a little deeper into this. What's your take on valuations for the early stage startups? I know, some of them you said are coming in like very big valuations, but how do you gauge that? What do you look for that valuation? How do they get to that number?
Comparables are the name of the game. If you're asking, I feel like implicit in that question is, have things come back down to earth? I would argue that they have, to a large degree. I would say larger than I thought, quicker than I thought, but I'd be curious to hear your takes on that. Every investor is doing their math in their head, and they're thinking, what's the best case scenario here if I put in at this valuation or that valuation, based on market, based on how big I think this product or this company could be. And the math gets cut in half in terms of how great it could be for us based on how high your valuation goes, right? So we're thinking this could be double plus good if it comes down at a certain percentage. So like, you have to understand, especially at seed level and at the earliest stage levels, if the math is too big right out of the gate, it like basically prices out our ability to have a successful investment.
Mm-hmm.
And so, I mean, right out of the gate, if it's too aggressively expensive, then even if I love the company and the founder, I got to walk, because I won't be able to make a good enough return to justify it. So,
yeah. And then also later raises, like if they're raising, they're going to have to, increase the valuation. Hopefully they'll hit certain benchmarks to justify that increase. A lot of times they're not. And so it's like, then they have a down round, and that doesn't, meaning the valuation is even lower now, this like new round. And that's, just not a good thing. And so just being really realistic with your valuation. Actually, before we came here, we were looking at fund economics for the new fund and like looking at what are seed round, like, pre-money before they get the funding, and then post, and then kind of modeling that. So, VCs, we create a model and look at it. And so, yeah, like even though the deal may be incredibly great and we love the idea and we think it could do really well, but if it doesn't make economic sense from a fund perspective, we have to pass on it. And so I think founders need to understand what VCs have to do. So as much as founders are going out and getting investors, we have to do the same thing, and we need to have a return to our investors, right? And so we've got to look at all those different things. And so I think a lot of founders don't put themselves in our shoes, which makes sense because that's not the shoes they walk in. But there's certain things that we're accountable for, and we want to return the fund and, much more. And that's like our reality. So.
That's great.
Yeah, for us, we have pretty set guardrails when it comes to valuation. If it hits a certain threshold, goes past it, we won't even look at it for the most part. And in terms of finding those valuations, we do look primarily on private and public comps, looking at EV, the revenue multiples mainly, and yeah. So ultimately, we look for sub 10 million. Pre-money valuation. That's what we just kind of generally look at right now.
What have you guys been seeing in terms of the valuations maybe coming back down to earth a little bit?
Yeah. Definitely. Yeah. Particularly well in later stage. Not that we do a lot of investment in later stage, but we've had a couple. But no, I mean, seed has gone down a bit. Actually, seed is still, kind of a bright spot. The companies that are that have good cash burn or conservative or capital efficient, they're still, making revenue, their revenue is increasing, those companies, I still can maintain the valuation or increase their valuation. But just, investors are just being much more discerning about things. Whereas, yeah, just the frothy valuations have gone down. And if you do have that still frothy valuation, you have to prove why you have that and justify why you should have that valuation.
I second that. Especially if you're looking at Web3 or crypto, blockchain spaces, I see a lot of those valuations kind of coming down to earth. Mm-hmm. But the other defensible sectors in the revenue generating companies, valuations are pretty stable. They're still growing to a degree, in my opinion.
Yeah, at seed level, I think it has pretty much been holding steady. Mm-hmm. But it's the going into A and Series B and stuff where it is really tough right now.
Because the exits are tougher now. Right. Well, the IPO market is pretty much almost non-existent.
Right. When we use the term comps, what we're mm-hmm. saying is there was a period of time where companies were going public on the regs mm-hmm. at 100x times sales and things like that. So those were the comps that could justify a huge valuation, because if everybody can go public at $8 billion because they're a SaaS or whatever, then okay, the math does make sense. But then it doesn't make sense now if the comps are there is no IPO, and even if you get an IPO, it might be a sub $1 billion IPO, not even a unicorn IPO. So again, when mm-hmm. we say comps, that's what we mean, is that these exits, the comparable value of the company has come down. So the comparable value of the initial investment, in theory, should come down too. So.
All right. So the next question: how does the negotiation process work with these investments? Like to just sort of open that conversation up a little bit, Mike.
I haven't done so many myself when it comes to actual negotiations. To be quite honest, we are usually follow-on, and we usually just tend to follow whoever's leading, and those leads are typically either investor colleagues, co-investors, and all that of ours, and that we trust and understand. We do our own due diligence, but we tend to follow whatever their term sheets are. So, in terms of insights from me, I'm not the best person to ask, to be quite honest.
Fair. Fair enough.
Yeah, I would just add, we do follow on. We're not leading. My new fund will do a couple of leads, but usually just for, viewers' purposes, the way it works is, most companies need to get a lead investor, and they'll put in, maybe 30%, they'll take 30% of that raise. So if you're raising $1 million, just for discussion purposes, you probably wouldn't have a lead for $1 million, but for discussion purposes, they write a check for $300,000, $400,000, and then they'd be the lead. They set the terms of that. So, the valuation and whatever, and they sign that term sheet. That is not a legally binding document. Consult your attorneys, but that's not a legally binding document. They can actually pull out. And I've actually seen that recently with one of my companies. They had a term sheet and the lead investor pulled out. But that said, that then they can take that term sheet. You can take that as a founder and say, okay, here, Lorine, this is like what the lead investor has, given us, and do you want to invest? And so I can't negotiate on those things. A couple of things I can, like pro rata rights, meaning your next raise, you go out and raise, so that I don't get diluted. Every time someone raises, whoever's come in, their equity gets diluted or it becomes less. So I say, I want to keep the same amount. If I invested, took 1%, for discussion, 1% of your company, I want to be able to, and follow on, give you more money to keep that 1% stake. And so I'll negotiate for that, right? So we do that for pretty much all of our, so certain things we can negotiate for, but that's really it.
I have to say the same thing because we don't lead. The only caveat to that is when we do pre-seed, we'll be the first check-in. So in essence, we're leading, but you wouldn't think of it as leading. But essentially, the negotiations and the math on that for me is, if I'm assuming that you're taking my money so that you can work on this for 6 months to a year and get it to the point where we can then do an actual priced round or something like that. Maybe you're quitting your job to do this. So, or maybe you're, you're going to find a partner that needs to quit their job to achieve this. So all my calculation is, do I think that this is a fair price I'm going to buy you 6 months to a year? And do I believe that, and at this point, we're 100% investing in people there. Do I believe that 6 months you will get it to the stage where, okay, because I'm unlikely to follow on if you don't get it to that next stage. Can you get it to the stage where I'm going to follow on and I'm going to bring in somebody that's going to lead? So it's all about the people and feeling like if the time I'm buying you to build out this idea will actually get me to the next stage where the rubber hits the road.
It makes perfect sense. And so my last question here, we talked a lot about the deal flow. How long does this decision process typically take from start to finish? I know every case by case, some might take longer, some might take less time. But what does that look like? It's a couple of days, a couple of weeks, maybe a couple of months. And
it depends. I mean, I've done deals where it's been several months, and then some, we kind of have to get it to a decision pretty quickly. But I wouldn't say a couple of weeks. Definitely try to take our time to really do a deep dive. But I mean, as soon as a month to a couple of months, it just depends on, it just depends.
The longest I've had to wait to close a deal is because the leads are big fish that take a long time for sometimes good reasons, but most times not very good reasons, just the pure inertia of being big fish. But if that's not the case, there's a lot of times, and maybe this happens to you two too, where it's because we're not leading, if it's a round that I know I want to get in on, it's not uncommon for me to talk to the company for the first time at the beginning of the week and try to get my check in by the end of the week. That is not uncommon at all.
For us, there's one deal, the one that we're working on right now. We're co-leading, but we're just co-leading just because of our check size. Someone else is doing the leading in terms of term sheets and what have you. But that deal is taking us close to 6 months, and it's because of mainly diligence and just crossing the T's and dotting the I's in terms of looking into the intellectual property and the patents that they filed, just making sure everything's above board, and just reviewing the team members, employees, contracts, and what have you. But in terms of other deals that we're looking at right now, we've said yes as quick as 2 weeks. And that's because we've known the team, we knew what they were doing, and the check size reflects that time as well, because that check was a much smaller. So yeah, it's a bit of give and take in terms of like how quickly we could get to an answer, and it just depends on that check size, in my opinion, at least for us.
Great, great feedback. I just want to take the time to thank you three for taking time today to go through our panel discussion and answer these questions. Thank you so much for your feedback. We got a lot of great takeaways today, and I just wanted to thank you guys very much.
Thank you.
Thanks for having us.